Hey everybody, it's Larry Berman here. Lot to unpack this week. Markets were incredibly volatile. Before we get into the chart room, I want to take a minute to congratulate Business News Network, BNN Bloomberg, for 25 years of outstanding coverage to Canadians. I'm thrilled to say I was literally there from day 3. In fact, I don't think there's another person on air on a regular basis on BNN that was there since the early days with me. Andy Bell is probably a very, very close second to that. And if you haven't caught the video on YouTube that was put out earlier this week, maybe we can share a bit of that clip now.
25th anniversary, and plenty has happened since we signed on as ROBGV. Quite a few of you have been with us for the past quarter century. Here's a look back at some memorable moments from the past 25 years.
Hi there, good morning. Welcome to the Open on BNN Bloomberg. I'm John Ehrlich-Ban.
I'm Andrew Bell.
I'm Amanda Lang.
I'm Paul Bagnall.
I'm Amber Canworth.
3, 2, 1. Roll red.
Good morning. I'm Maria Mirabella. It's September 1st, and you're watching equity and bond markets were down yesterday on news that manufacturing prices were up.
You know, it was 25 years ago, and I was one of the first guests on Market Call, and a few years later, a head of BNN came to me and said, "Larry, you're our top number one Market Call guest for the last number of years, and we'd like to build a show around you and lever off the theme Market Call and make it Berman's Call." And I was extremely flattered at the time and went to my employer at the time, which was, CIBC, and went to them with that idea, and they shot it down. And so ultimately, when I left about 18 years ago to found ETF Capital Management and Quintessence Wealth in more recent years, Berman's Call was born in 2007. So in our 18th season now, and really excited to come to you with these educational clips that we do every week. But this week is a sad week, because all we'll know a couple of years later, after BNN started, we had 9/11. This is a picture actually that I keep on my home office wall of the old trade towers. I did an internship on Wall Street in the early 1990s, and I actually was right there. My friend Phil Roth, who was at Dean Witter at the time, is who I was working with, and the plane hit, I think, 5 stories above his office. This is a picture of the CIBC World Markets office that was in the World Financial Center, kitty corner to the towers when everything came down. And so this week we memorialize the loss there, and let's never forget what some of these issues are when we're talking about geopolitical risks and things that are happening in the world today. And sometimes people have very, very short memories of the people we need to not like in the world that cause a lot of the grief. Anyways, just a moment of silence in that regard would be great. Well, thank you for that, and let's dive into the chart room and see what the markets are telling us. The world interest rate probability function is a calculation that looks at the futures markets in different places in the world and estimates what the probability of a rate hike or cut is. And so we can see now, looking out a year in the US market, there's almost 10 rate cuts. In fact, if I roll this out one more month to December 2025, we've got 10 25 basis point rate cuts priced into the futures curve. And so to me, that is a hard economic landing. When we look at projections of the street, the Fed, and in this case, Bloomberg Analytics, which I'm going to change screens here and hopefully share that with you. We're looking at the the white line is the historical unemployment rate in the U.S. up to the most recent non-farm payroll report, where for a rounding error it was 4.2. Really, it could have gone either way. It was really a fractional rounding error. In terms of forecast, the last Fed dot plot we get another one at the September 18th FOMC update, but the last dot plot had the expectation for the unemployment rate in the U.S. for December 2024 at 4%. So we're already above that now, and hence why in recent months the Fed is now moving towards the beginning of the rate cut cycle. When you look at the street consensus forecast of the unemployment rate, the street out to the end of 2025 is actually very benign in their view, where the unemployment rate only goes up to 4.4 and then starts coming back down into the second half of 2025. So this naive view or this more benign view of a softer landing for the US economy. Bloomberg Economics runs a model that's based on, let's say, more realistic data, but Bloomberg being independent of the street, where they don't have a business, where they've got to say nice things or companies won't talk to them and that kind of thing. Probably a more realistic path of where the unemployment rate will be. And so if you look at where that is, they're projecting it rising out to 5% based on, in their modeling, what normally happens at this part in the business cycle based on history, etc. Saw a very good interview today with the head Bloomberg economist talking about the revisions to payrolls, what we're likely going to see going forward, the birth death model, and ultimately what that means, and really standing behind her forecast out here on what's more likely to happen. So hard landing, soft landing, Fed being out to lunch and well behind the curve. When you bring that back and look at what's priced into the curve, you really get the understanding of where things are ultimately at. And so that's the big thing. The SOM rule updated. Again, if the 3-month average of the unemployment rate rises above the cycle low by 50 basis points, it always triggers a recession. She's been in the media big time lately. It's never missed as a call. She's downplaying it a little bit, but I think that that's more of her personality versus what's likely to happen. And so, again, contrast that with the S&P 500 here, and you really get an idea of where things are at. In the next couple of weeks, we get a lot more bond supply coming out. So when we look at TLT, if we were to look at TLT and not understanding what it is, and it's just another ticker, and we were doing basic technical analysis on it, you would argue that we've got a bottom developing here, a trend line here might be broken. Where can this rally to? You would argue that this could get back to 110 to 113, 14 before we start to really run into some resistance. If we blow this up here and look at the last year or two, from the last year perspective, the last time we got late last year up to yields in the 30 and the long end here, market rejected it. It rejected it because the economy was stronger. So now the economy's weaker. But when the UPenn updated when UPenn updated Harris and Trump's policy proposals and what it would mean for deficits, folks, there's trillions and trillions and trillions and trillions of new debt that needs to be funded to pay for all the mismanagement of the fiscal purse over years and years and years, boosting debt to GDP up to in incredible levels. And everybody off the record will tell you the fiscal path is unsustainable. And so I think this limits the bond market's ability to rally. second only to how much money comes out of equities and goes into bonds. So looking at the equity charts, very simply here, what just happened? Market failed to break out, double top, we're breaking down. We confirmed the breakdown below the 50-day average. When that happened in early August, look out below. Where is support? So we've got the Fibonacci, we've got the rising 200-day, and we've got this projected trend line off the last couple of lows. Take that out into the Fed meeting, which is where my line's up here, and we almost certainly have another test of 5,200 coming on the S&P. So about 4% lower than when we went out. You know, we really need to break this chart in a big way, the 200-day, the trend line, the August lows. If that happens, where are we going? And we're easily going to the 50% retracement around 4,900. So all those things are into play. Seasonal weakness time, September, October, U.S. election uncertainty. Where does it all stop? Hard to say, but right now our cautionary messages of the last number of months in terms of equity market valuations remain, and we're cautiously, wanting to buy dips at this point. But the question is, where are those dips to be bought? And I suspect, we're coming back to the 50% retracement in that range. In a worst case scenario, next few months. In a best case scenario, we hold at the 200-day and bounce off that. But in order for that to happen, we need the employment numbers not to disintegrate here and really come down. And if we see that over the next couple of months, where the unemployment picture gets worse and worse and worse, then the Fed would need to be more aggressive. Earnings will come down, and the multiple can't stay where it is today. Unfortunately, that's the message that the markets are telling us this week. Have a good week, everybody.